Barron's is suggesting that analysts are getting more optimistic on chip makers, which is very interesting because that's a sector that I've largely been analyzing on this channel, but it's not a sector that I've been investing in as of yet. I'm still waiting for the stocks to come down a little bit more, but as you guys smash that like button, let's get into this article. What's up, guys, and welcome back to the channel. Let's dive right into this one because I think it's a very important article because it is taking a view that's opposite of the view that I have at the moment based on the current valuations for chip makers like NVIDIA, AMD, etc. So you can see here's the article from Barron's, and they're saying that AMD, NVIDIA, and 3 other chip stocks it's now time to buy them because they've effectively priced in the downturn. And so what they're really going in and they're saying that is that AMD and 4 other chip stocks are considered buying opportunities by KeyBank Capital Markets. So we can only speak on behalf of KeyBank Capital Markets in this video. And they're saying that that's because of the huge drop in the price of semiconductor shares. And so I'm not saying that you're wrong when you say that because the share price have declined, that there is less risk in the environment for these particular securities. That's exactly what's happening. When the share prices decline, risk does come off. However, what exactly are they getting into here? And notice here that Vin noted that the forward price to earnings multiple for the chip sector has dropped by 55%. He's saying that right there. And so the analysts is optimistic that the chip sector will be a little bit more resilient this time. And the reason why he's saying that is because it looks to me like he's suggesting that the industry is more consolidated, which he's not wrong. And so that should lower the risk of excess capacity driving down chip prices. Now, I would say that he's probably right in most areas, but maybe not necessarily the personal PC market. That's still really pressured by an inventory glut. And we saw that in Intel's earnings report that recently was released. And we also saw that in AMD's earnings report, which was also recently released, and I'll show you that in their numbers in this video. And so he goes on to say that there are several secular growth trends, including 5G, the move towards electric vehicles, cloud computing, and artificial intelligence that should help soften the magnitude of the downturn. And I do think he's right. Like, one of the reasons why I like AMD and NVIDIA is because they're so future focused. They're moving into the EV space, the 5G space, the embedded space as well. That's something that I really like AMD, or something that I like about AMD. And so he's not wrong there. And so the first stock that he does like or mentions, and I'm going to highlight, is AMD. He's saying that they have an $85 price target on the security, and that's fair. But what exactly do I have as a price target on this security? Well, you can see right here, this is actually from my model. And like I always tell you guys, you can get access to all of my models and all of the valuations at that lower tier of the Patreon, which is just $5 a month, which is essentially just buying me a couple of coffees every month to get access to all the research that I do on the securities that I tend to invest in. But if we go back into this valuation, you can see that using a terminal multiple of 15 times earnings, I'm giving this company a valuation of approximately $70 per share. But I'm going to show you how I can be very wrong on this valuation. So what that really means, and if you read into that, I'm telling you, don't ever look at any valuation on this channel as a recommendation to buy the securities. Always do your own analysis. But if we go right back into it, you can see that the current share price is $71.58 as of the recording of this video. So the company's not expensive for such a future focused operation, trading at 18.6 times earnings. So it's a fairly valued company. And, you know, I always say on this channel that if you're paying a fair price for what I would consider an exceptional company, because I do believe AMD, NVIDIA, they are exceptional companies, then I think that's okay. But just from my perspective, I'm a huge margin of safety investor, so I'm going to stay away from AMD right now based on the current discount to intrinsic value, or lack of discount to its intrinsic value. Now let's dive into exactly why I think I might actually be a little bit pessimistic on AMD's growth or revenue growth over the long term, and hence why I believe that my valuation might be a little bit low. So here is their historical income statements. And so you can see that their growth has been a little bit choppy since 2017. Their growth has really accelerated, and you can see I've highlighted up here. You can see that their computing and graphics segments grew at 51.3% in 2017. Then, it maintained 30% in 2018 and 2020. There was a bit of a lull in 2019, and then it really accelerated in 2021. And then, of course, the enterprise. So this is, your cloud computing and stuff. It grew at 64.7 and 113. But what is the first thing that you see when you see this? One of the things that I see is that one of the questions that I would ask is this sustainable into the future? And look, you guys might actually have a better idea of whether or not this is sustainable than I would. And so I'm just not sure. And now going into the forecast, you can see that 2022, well, the first thing that I do want to show you is notice that the segment revenue view, you have this old view, and now you have this new view. And the reason why is they're breaking out their segmentation differently going forward. And I think that's great because the two areas that I'm really focused on for them is their data center and their embedded segment. And so notice how I'm forecasting these out. Now, I am very optimistic on the data center. I'm a huge believer in the cloud. And so you can see that I'm growing the data center out at 10% a year in 2023, 15% as a recovery in 2024, and then, just around 12.5% thereafter. And then with the client segment, this, of course, is the segment that is very overloaded with inventory right now. So I do believe that it goes backwards. It could actually go backwards by 10% in 2023. We don't know. I don't think there's any growth thereafter. I think the inventory glut takes some time to settle out, but I might be a little bit pessimistic here. You guys let me know what you think. And then I just go to 5 and 7.5%. This 7.5 might actually be too large. So, I don't know. You guys let me know what you think. And then with the gaming segment, I think gaming is somewhat mature. It's still growing, and so I'm giving it a 5% in 2023 and then a 7.5% thereafter. That might be a little bit low. Once again, you guys let me know what you think. And then with the embedded segment, I think this is where there could be a lot of growth, and so I'm growing it at around 12.5%. But once again, that you guys might consider me a little bit too pessimistic on the future growth of the company's segments. But once again, the two segments that I am more of a bull on are the data center and the embedded segment. So overall, I think that revenue growth really slows down to around 5% in 2023. And then, just in the low double digits thereafter into effectively 2031. And then, of course, we throw a perpetuity item there, which brings down the growth even more. So using that 11.5% discount rate. So you guys let me know what you think. Now, here's what the business really is. So if you guys are not familiar with AMD, they are essentially 4 segments, but really just 2 large segments right now. I guess 3 main segments. They got the data center, the client segment, gaming, and the embedded. The 2 segments, of course, that I'm most bullish on are the data center. I'm a really big believer in the cloud, and I really do like their embedded segment. This was an acquisition that they made to enter this market, and I think it's really good because, the client segment, this is, your laptops that you're purchasing. I think this has a bit of an inventory glut right now, so it's going to be a challenge for them. And then, of course, the gaming segment, there's just been a slowdown because of the crypto mining. So I don't know what this segment looks like going forward, but, they still have other areas where they're growing, like there's still PS5s being shipped out, Xboxes, etc. And so 5 to 7.5% growth into the future. I think that's reasonable, but once again, you guys might just be very much more optimistic than I am, and that's totally cool. It's totally okay to disagree with valuation. And so just diving a little bit further into the segments, so you can see here, this is the data segment that they reported in the past quarter. So notice that revenue is actually up considerably, up 45% year over year, and their operating margins are also up. And so what's happening here? Well, you're seeing 10 straight quarters of record server processor sales driven by their new processor. So just exceptional performance despite the overall industry slowdown for chips. But of course, with the data segment, it's not that story. And I think that this continues forward. But I would point out that if there is a deeper recession into 2023, I would say that some corporations would slow down spending. So you could even see a bit of a slowdown in the data segment. I'm not totally convinced that you're going to see a slowdown in the data segment, so that's why you're not seeing it in my numbers. However, it could very much be a possibility. Now, the next segment that I do want to go into is their embedded segment. So you can see here that once again, the embedded segment has grown significantly, but notice that the comps are a little bit off because this is a new acquisition. So let's see how this performs over time. I like the fact that they're mentioning that they have record aerospace, defense, automotive, and communication sales. That's what you want to see here. Now, what does their outlook look like? So let's take a look at the next slide. These are their outlooks for fiscal year 2022 and Q4. So notice that they're getting healthy margins and healthy levels of growth. So overall, in the fourth quarter, of course, growth is slowing down. They're only expecting 14% year-over-year growth. Recall, guys, that I'm slowing down growth considerably in 2023 because I'm seeing the quarter-over-quarter growth starting to slow down. So it's just getting effectively what the street would call lower comps or worse comps. And so I'm seeing that. That's why you're seeing me put so much emphasis on a slowdown or expected slowdown in fiscal year 2023. So just keep that in mind. But just going back here, you can see that overall for 2022, they're expecting revenue growth of 43% year over year. But part of that is just they just had a good first and second quarter. I wouldn't forecast out 43% revenue growth into 2023. I would absolutely not do that. But notice how their margins are still pretty solid for the year and for the quarter. That's very healthy. I love seeing that. So we'll see what this looks like going forward. Now, I want to move into the next company, and it's also a company that I've covered on this channel that they're discussing in the article. And so that name is actually NVIDIA. And so let's just get into that. So you can see here that in the article, they're saying that NVIDIA is actually valued at $230 per share. So the question is, what exactly is my valuation on NVIDIA? And so I think that helps a lot to just sort of understand this. Well, notice how much lower my valuation is. But once again, I could just be a little bit pessimistic here, right? So I'm using a terminal multiple of 15 times earnings. I have a valuation of $130 per share, add in that excess cash of $5 per share, and you get $135 per share. It's trading at 81 times EPS. Now, the thing about NVIDIA is that there's just a lot more growth expected, but of course, it's expensive relative to its current share price. Now, there's a lot of you who would say, look at the EPS for NVIDIA. Look at the EPS for AMD. It's very clear that AMD is a safer option. And if you look at the EPS multiple that Intel is trading at, it might actually be the safest option overall of the three. And I wouldn't blame you if you want to just take a lower earnings per share multiple and dive into sort of Intel. But where I would sort of caution you with Intel is that they are 50% or more, or slightly more than 50% in that consumer segment, which is a segment that has the inventory glut. So just be careful. And the other thing is they're not outsourcing their foundry to TSMC or Taiwan Semiconductor. And so they don't actually have the best chips. That may not necessarily be an issue in the consumer segment, but it does become an issue in their other segments that they're trying to go after. And so let's see how that plays out. But I just don't see Intel as future focused as AMD and NVIDIA. Now, let's dive right into my NVIDIA historical numbers. So you can see that overall, you can see that the company's revenues did grow by considerable amounts, especially in 2017, 2018, 2019, and then, of course, the last 2 years. But the question is, should we expect these revenues to grow at this rate into the future? I don't think so. But you guys might say that I might be a little bit too pessimistic on gaming. Now, I'm excited about the data center and the auto segments. Also, I really like NVIDIA as a company more than I like AMD, but, you know, it's not as cheap as AMD from my perspective. So, you know, in 2023, I'm expecting the data center to grow at 30%. I think that's kind of in line with their guidance, but 2024, I'm bringing it down considerably. You know, gaming, I'm not growing out at all. So similar story to AMD with their professional visualization. I don't know about this segment. It's really hard for me to understand it and value it forward. And so I'm saying just 0%. Notice that it's going backwards this year. So just be careful about that. With the auto segment, I'm a bit of a bull on the auto segment. With the move towards autonomous driving, I think you just need more computing power. And so this segment continues to grow up, but I might be wrong here. But once again, here's the main takeaway that I want you guys to take away. Here's where I might be a little bit too pessimistic. Notice that I just have high single and then low double digit growth rates out into the next 10 years. So I might be a little bit pessimistic there. You guys let me know what you think, but let's actually dive into some of these segments and let's see what's going on. So the first segment I want to dive into is the data center segment. So notice that data just exploded this year, and I don't see that declining. And so what are they saying are the growth drivers? Well, rapid adoption, of course, for AI. They have a 3-chip strategy. And then, of course, I just think it's an overall secular demand growth for this segment. And so I'm really happy that they are in the data center segment. Now let's jump into gaming. You can see here that with gaming, the graphics business essentially has struggled in fiscal year 2023, but long term, I do believe it still has a secular growth story. So we'll see how this segment plays out. Now let's dive into the automotive segment. You can see that auto is really small right now relative to their other segments. However, I think this could be one of their largest segments in the future. And so, you know, the fact that they're calling themselves the leader in autonomous driving, that's really what I want to see, because as we move forward into the future, I really want to see them being sort of like a future-focused company in the chip space. But once again, the valuations are a little bit high, as I've showed you in these videos, despite what the analysts are saying. This is what value investing is all about, right? Sometimes in the newspaper, you'll read something and you'll say, okay, this guy is making a really good case for these companies. Let me see what I'm valuing them out at using my models, and let's see if it makes any sense. And in this situation, it just doesn't make sense. However, I do have a reprieve for you guys. In the tracker that the Patreons get access to, you can see that we have a ton of companies that are trading at 75% or less than their intrinsic value. And so, you know, I cover some of these names sometimes on the channel, but of course, at the lower tier of the Patreon, you can get access to all these. And so if you're not interested in chip makers, no problem. I'm seeing major themes in the US housing builders, which I've covered on this channel before, international commerce, media, online platforms, consumer fashion, and the experience industries. And so there's a lot there. Now, speaking of the glut in the sort of chip maker space, one company that is struggling right now is HP, the seller of computers. But I do believe that this company's trading so low right now that it could be a pretty interesting opportunity. I'm calculating for them to have an approximately 13% equity yield. And if you're interested in that video, you can get to it right here.